Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
All right, so welcome to the deep dive.
Yeah, welcome everybody.
Today we're going to tackle a question that I think is really at the heart of how businesses operate. What do companies actually do with their profits?
Yeah, it's a really good question.
Once they've, paid their employees and covered their expenses,
Paid their taxes, hopefully.
paid their taxes, what happens to that extra cash?
Right.
What are their options?
Yeah,
And that's where dividend policy comes in.
that's exactly right.
So today we're going to do a deep dive into corporate dividend policy.
Okay, sounds good.
And I think, this is something that's relevant for anyone who's interested in, corporate strategy
Yeah.
or the financial health of a business.
How to analyze a company, absolutely.
So for this deep dive, we've, pulled together some really interesting sources.
Okay.
We've got, kind of some of the basic foundational stuff on dividend policy.
The nuts and bolts.
Exactly. The nuts and
The
bolts.
101.
We've got examples of real world companies with, very different approaches
Yeah, contrasting approaches.
to this decision-making process.
Right.
And then even, a bit of a look behind the scenes at how finance teams grapple with these questions.
Yeah, the finance team is really at the heart of it.
Yeah, absolutely.
They're the ones making these decisions, so.
So I think the mission for us today
All right.
is to really distill the most important insights from these sources,
Okay.
explore, the trade-offs involved, and really try to understand what these decisions signal about a company's strategy
Right.
and its future prospects.
What they're thinking about the future.
Yeah, exactly.
Yeah.
So to kick things off, why don't we just, lay the groundwork here?
Okay, sure.
What exactly is dividend policy?
So at its core,
Yeah.
dividend policy is basically the framework that a company uses to decide how much of its profits to return to shareholders
Okay.
versus how much to keep in the business to reinvest.
And, when we talk about returning profits to shareholders,
Right.
what are the main ways that companies actually do that?
So the main ways are either through cash dividends,
Okay.
which are literally just checks or, deposits paid out to shareholders,
Uh-huh.
or through share buybacks,
Okay.
which is where the company goes into the market and uses its cash to buy back its own stock.
Okay.
So they're reducing the number of shares outstanding.
Got it. So it's not just about, whether or not to pay out cash.
Right.
It's also about, choosing the mechanism for how to do it.
Exactly right.
Interesting.
It's a multifaceted decision.
It seems like these decisions can, really send a strong signal to the market
Absolutely.
about how a company views its own future.
Yeah, it really does.
What is it thinking?
A company that pays a dividend is basically saying, look, we're generating consistent profits.
Right.
We're confident about the future.
We believe in ourselves.
We believe in ourselves, and we're willing to share those profits with you, the owners of the company.
Uh-huh.
And on the other hand, a company that decides to hold on to its earnings and reinvest them in the business might be signaling that it sees even bigger growth opportunities down the road.
Okay.
That they think they can get a higher return by reinvesting those profits than they could by paying them out as dividends.
Interesting. So it's like this fundamental trade-off
Yeah, it's a classic trade-off.
between, rewarding shareholders in the present
Right.
versus investing for future growth.
That's exactly right. And you see different companies, take different approaches to this all the time.
Yeah. I mean, I guess it depends a lot on the type of company,
Of course.
the industry, its stage of growth.
Yeah.
Right.
Yeah, absolutely.
So do you have any examples that come to mind of companies that have, sort of famously taken one side of this trade-off versus the other?
Yeah, absolutely.
Okay.
So a really classic example of a company that prioritizes dividends is Coca-Cola.
Okay. Yeah, makes sense.
They've been paying dividends for over 100 years.
Wow.
And they've actually increased the dividend every year for, I think it's like 60 years in a row.
Wow, that's incredible.
So it's this really core part of their identity
Yeah.
and a key way that they attract and retain shareholders.
I guess their business is pretty stable, right?
Yeah, they're a mature business with very predictable cash flows.
They sell a lot of soda.
They sell a lot of soda all over the world.
Yeah.
So they have this consistent stream of earnings, and it makes sense for them to return a significant chunk of that to shareholders.
Yeah, makes sense. So on the other end of the spectrum,
Right.
who comes to mind?
Well, for a long time, Amazon was the poster child for the reinvestment strategy.
Okay, yeah, I remember that.
For years, they didn't pay a single dividend.
Wow.
They were all about plowing every dollar back into the business,
Yeah.
building out their logistics network,
Yeah,
investing in cloud computing,
right.
expanding into new markets.
Yeah, they were just growing so aggressively.
Exactly. They were laser focused on growth, and their bet was that those investments would pay off in the long run.
And I guess for their investors, it seems like it paid off pretty well.
It did for a long time. I mean, the stock price, went up and up and up.
Yeah.
So even though they weren't getting any dividends, those early investors
Right.
were rewarded through the appreciation in the stock price.
Makes sense. And I guess Tesla's been another company that's followed a similar playbook.
Yeah, absolutely. Tesla's another great example.
Yeah.
They've been pouring money into R&D,
Right.
battery technology,
Yeah.
scaling up their manufacturing, global expansion, all that stuff.
Yeah.
And so far, they haven't paid any dividends either.
Interesting.
But again, their stock price has reflected that growth.
Right.
Investors are betting on their long-term potential.
So it really highlights that, trade-off between short-term rewards
Right.
and long-term growth potential.
Exactly. And it's not an easy decision for companies to make.
Yes.
It really comes down to how they view their own opportunities.
Their cost of capital.
Yeah, the cost of capital, all those factors.
Yeah. Okay, so let's talk about a concept that I think is really helpful for, kind of quantifying this whole discussion.
Right.
And that's the dividend payout ratio.
Yeah.
So what exactly is the dividend payout ratio?
So the dividend payout ratio is simply the percentage of a company's net income
Okay.
that gets paid out as dividends.
Right.
So if a company earns $100 million in profit and they pay out $60 million in dividends, then their payout ratio is 60%.
Okay, so it's basically just a way to see,
Right.
how much of the profit is going back to shareholders versus
Exactly.
how much is staying within the business.
Yeah, it gives you a quick snapshot of their dividend policy.
And is there like a magic number?
I wish there was.
So this ratio?
It would make things a lot easier.
Yeah.
But unfortunately, there's no one-size-fits-all answer.
Yeah.
It really depends on the company, the industry, the growth prospects, all those things.
So could you give us some examples of maybe typical payout ratios for
Sure.
different types of companies?
Yeah, so, as we were talking about before, mature, stable companies, like utilities or consumer staples companies,
Yeah.
those companies often have higher payout ratios,
Right.
maybe in the 60% to 80% range,
Okay.
because they have these stable, predictable cash flows.
Right.
They don't need to reinvest as much for growth.
Makes sense.
And so they return a larger portion of their earnings to shareholders.
Yeah, I guess those investors are probably looking for that income.
Exactly. They're often income-oriented investors
Yes.
who
Yep.
rely on those dividends for, retirement income or whatever it might be.
Makes sense. And then on the flip side, what about those, high growth companies that are really reinvesting heavily?
Well, those companies might have payout ratios of zero.
Zero.
Or very close to zero.
Okay.
They're basically saying, we're going to put every dollar back into the business
Right.
to fuel that growth.
Yeah.
And that's where all the value is going to be created.
It's all about the future.
Yeah, exactly.
And I guess it's not just about the growth rate. It's also about, how effectively they can reinvest that cash.
Yeah, it's about the return on invested capital.
Yeah.
And, the finance team plays a big role in analyzing that.
Okay.
They're looking at the company's free cash flow,
Uh-huh.
which is the cash that's left over after all the necessary investments.
Right.
They're forecasting future capital expenditures
Okay.
and really trying to model out
Yeah.
what the optimal payout ratio should be.
Interesting.
It's a complex process.
Yeah, it sounds like it.
But it's really important.
So we've talked about dividends quite a bit.
Right.
But you mentioned earlier that stock buybacks are another tool
Right.
in the corporate finance toolkit.
Yeah, share buybacks are a big deal.
So can you remind us, how do stock buybacks actually work?
Yeah, so with a stock buyback,
Yeah.
the company basically goes into the market
Uh-huh.
and uses its cash to purchase its own shares.
Okay.
And those shares are then retired,
So they disappear.
essentially.
Yeah.
Yeah, they disappear.
Interesting.
They're no longer outstanding.
So what's the rationale behind doing that?
So there are a few reasons why companies might choose to buy back their stock.
Okay.
One reason is that it can increase earnings per share.
Okay. How so?
Well, because you have the same amount of earnings, but fewer shares.
Right.
So each share represents a bigger slice of the pie.
Makes sense.
It's simple math.
Yeah.
Another reason is that it can signal confidence
Okay.
to the market.
How so?
Well, if a company is willing to buy back its own stock,
Uh-huh.
it's basically saying, we think our stock is undervalued.
Okay.
We think it's a good investment. And that can boost investor sentiment.
And I guess it's also a way to return cash to shareholders
Right.
without having to commit to like a regular dividend.
Yeah, exactly. It's more flexible
Okay.
than a dividend.
Yeah, that makes sense. And we've seen some, really big companies
Oh, yeah.
use buybacks pretty aggressively.
Absolutely. I mean, and Apple,
Yeah.
Microsoft, those are some of the biggest buyback companies out there.
Yeah, I mean, they've returned, billions of dollars to their shareholders this way.
It's enormous amounts of money.
Yeah.
And it's become a very popular way
Uh-huh.
for companies to manage their capital.
But there's also been some, pushback against buybacks.
Right. There's
On-
definitely been some controversy.
Yeah.
Some people argue that buybacks can actually hurt long-term investment,
Okay.
that companies are basically using their cash to boost their stock price
Uh-huh.
instead of investing in, new products or R&D
Right.
or, their employees.
Okay, so it's kind of this ongoing debate
It is.
about, the best use of corporate cash.
Yeah, and there's no easy answer.
Right.
It really depends on the specific circumstances of the company.
So beyond, kind of the internal dynamics of the company,
Right.
what are some of the external factors that can influence dividend policy?
Well, one factor that definitely comes into play is taxes.
Okay.
Different countries have different tax rules
Right?
around dividends and capital gains. So that can definitely affect how companies think about, dividends versus buybacks.
So could you unpack that a little bit for us?
Yeah. So in some countries, dividends are taxed as ordinary income
Okay.
for the shareholder,
Uh-huh.
whereas capital gains, which is the profit you make when you sell a stock,
Right.
might be taxed at a lower rate,
Okay.
or the tax might be deferred until you actually sell the stock.
Interesting.
So that can make buybacks more attractive
Uh-huh.
from a tax perspective.
Because you're essentially deferring that tax liability
Exactly.
until you sell those shares.
Right.
Makes sense. Okay, so beyond taxes, what else?
Well, another really important factor is signaling.
Okay, yeah, we touched on this a little bit earlier.
We did.
But could you explain
Yeah.
what exactly we mean by the signaling effect?
So when a company announces a dividend or a change in its dividend policy,
Uh-huh.
it sends a signal to the market about its financial health
Right.
and its future prospects.
So, for example,
Yeah.
if a company initiates a dividend or increases its dividend.
It's usually seen as a positive sign.
Right.
It suggests that the company is confident about its future earnings.
They're willing to share those earnings.
Exactly. They're putting their money where their mouth is.
Yeah.
On the other hand, if a company cuts its dividend,
Yeah.
that's often interpreted as a sign of trouble.
Okay.
It might suggest that the company is facing some challenges
Uh-huh.
or that its earnings are not as strong as they once were.
So it can really spook investors.
Yeah, it can definitely lead to a drop in the stock price.
Makes sense. And then I guess another factor that plays into this whole signaling game is investor expectations.
Right, because different investors have different preferences.
Yeah.
Some investors are really focused on income.
Right.
They want those steady dividend checks,
Right.
and they're willing to accept maybe a lower rate of growth.
Ugh.
Other investors are more growth-oriented. They're
Yeah.
willing to forego dividends
Mm.
in the short term because they believe that the company is going to reinvest those earnings and generate even bigger returns down the road.
Okay. So it's really important for companies to understand,
Yeah,
who their shareholders are,
absolutely.
what they're looking for.
And what their expectations are.
Yeah, because ultimately
Right.
those are the people that they're accountable to.
That's right.
Okay, so we've talked about, kind of the big picture of dividend policy.
Right.
But I'm curious to get a sense of, how these decisions actually get made
Yeah.
inside a company.
Okay.
What's the process like?
So the finance team really plays a central role in this whole process.
Okay.
Whether it's the FP&A team, the controllers, or the CFO,
Right.
they're the ones who are crunching the numbers,
Yeah.
running the models,
Yeah.
and ultimately making recommendations to the board of directors.
Okay, so what are some of the key things that they're looking at?
Well, one of the most important things is forecasting free cash flow. which, as we discussed earlier, is the cash that's left over after all the necessary investments in the business.
Right.
So they're looking at, historical trends, industry benchmarks, and, their own internal projections
Makes sense.
to try to get a sense of how much free cash flow the company is likely to generate in the future.
Okay, so they're basically trying to figure out,
Right.
how much cash is actually available
Exactly.
to potentially return to shareholders.
That's right.
Okay, and then beyond free cash flow, what else?
Well, they're also looking at the company's capital structure,
Okay,
which is basically how much debt the company has
right.
versus how much equity,
Okay.
because that can affect its financial flexibility and its ability to pay dividends or buy back stock.
So if a company has a lot of debt,
Right.
it might be more constrained
It might be.
in terms of
It might have less room to maneuver.
how much it can return to shareholders.
Exactly, because it has to make those debt payments.
Right, those interest payments.
Yeah.
Okay. And then beyond those kind of financial considerations,
Right.
are there other things that the finance team is thinking about?
Yeah, absolutely. They're also thinking about the company's strategic goals,
Okay.
its investor profile,
Right.
and its long-term vision.
Yeah, it's not just about the numbers.
It's not just about the numbers, it's about the big picture.
Right.
So they need to collaborate with other parts of the organization to make sure that the dividend policy is aligned with the overall strategy
Right.
and that it's communicated effectively to the investment community.
Yeah, it's a complex decision-making process,
It is.
but it's clearly, a very important one.
It is.
So I think for our listeners today,
Yeah.
if there's one thing to take away from this deep dive,
Okay.
it's that a company's dividend policy is not just some random,
Right.
financial decision.
Yeah.
It's a reflection of its, core strategy,
Yeah.
its priorities,
Absolutely.
its outlook for the future.
And it can tell you a lot about the company.
Yeah, it's definitely something worth paying attention to.
It is.
So as you're, researching companies,
Right.
thinking about investments,
Yeah.
don't just look at the dividend yield in isolation.
Right.
Think about the broader context,
Exactly.
the company's history, its financial health,
Yeah.
its growth prospects,
All of that.
all those things.
It all ties together.
Yeah, and think about, whether the company's approach to dividends and reinvestment aligns with your own investment goals
Yeah, good point.
and your own understanding of the business.
Absolutely. That's a great takeaway.
So I hope this deep dive has given you some food for thought
Yeah, me too.
and some new insights into the world of corporate dividend policy.
It's a fascinating topic,
It is.
and it's always evolving.
Yeah, absolutely. So thanks for joining us,
Yeah, thanks for having me.
and we'll see you next time on the deep dive.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.